Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Tellurian's 2022 Q4 results. They're from their upstream gas production segment, and I'm going to be also looking at what 2023 might look like from their gas production and the potential free cash flows we could see from that. I'm not going to be talking about driftwood today. I'm going to be focusing on their um, upstream gas production, and I will focus on driftwood in a future video. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Tellurian, so this video should be for your entertainment purposes only, because I can be wrong about everything I say in this video, and you need to do your own research before making any investment decisions. So, 2022 Q4 was a pretty good quarter for Tellurian's gas production, and that was mostly driven by Henry Hub prices and their increased gas production. And they put out a nice press release. They said, "Hey, we increased our gas production a ton versus the prior year." A lot of that, as most folks know, was from their acquisition of the Insight gas production, and they averaged approximately 225 million cubic feet per day of production. And as you look at their results here, $102.5 million in revenue, adjusted EBITDA of about $80 million. I'll go into slightly more detail in just a moment of what that entails. So if you look through their numbers, I sort of have them here color coded. As I said, $102.5 million of revenue. Operating expenses there were about 19 million. Development expenses, and this is for their gas development, they build as 20 and a half. Some depreciation of 21.6. That's sort of an accounting thing, not a cash item. And then G&A for the whole company of $29.7 million. So overall, the way that I sort of am calculating here, they have operating income of about $11.3 million, even with this large amount of G&A for the whole company. Again, that's not just for the upstream segment, that's the whole thing. And then some other stuff that's not that important. And, in the end, they did have about $30 million of net income. Again, I care a lot more about their operating income and their free cash flow, which I will go to, in a minute. But if we look specifically at their upstream segment, because that's kind of what I want to look at. I'm looking at it from two angles. One is I want to look at what's their break-even point from their gas production, just if we look at, the upstream segment. And that's, to try to answer the question of, well, if they do decide to incrementally invest and produce more gas, what does their break-even point seem to be? And then I'm also looking at it from, in the 2023 timeframe, I really only expect them to be making revenue from their upstream gas segment. And so I also want to know, what is their break-even point for the company overall from this upstream segment when they are basically supporting, have to make enough profit to cover the G&A expenses for the whole company as they are trying to get driftwood up and running. And I'm not looking at them, I'm not expecting them to make the cash flows to cover the expenses in driftwood, right? That's its own thing, but at least to cover the G&A of the company so that we can say that this is actually a profitable, self-sustaining company in the meantime while driftwood is happening and getting financed. So I looked at it here. Again, their upstream segment, their operating profit they build as, this is what they had on that prior press release. The operating profit of $47.5 million, the depreciation of 21.5, allocated corporate G&A of 11.2, and that's how they come up with their, adjusted EBITDA for their gas production of $80.2 million. And again, this is an interesting figure. I actually don't care how much they allocate specifically to the upstream segment. That much, although I did look at it here, and you can see how would this vary actually given Henry Hub prices, right? So the Henry Hub price that they actually ended up selling at was just under $5, and that's how they got about $80 million of EBITDA. But I put in sort of a formula here to see, well, what if Henry Hub price was actually only $2, right? Because we've seen major swings in Henry Hub selling prices, or Henry Hub prices that they've been selling at. And, at $2, they would still be profitable there in terms of adjusted EBITDA, but it would be much, much less, right? And so I think from a break-even perspective, if you look at this, they're probably down around the $1 mark. But if we're looking at, right now we're seeing $3 to $3.50 per MMBTU for Henry Hub, and then going forward for a lot of 2023. And so you can see their looking at, quarterly adjusted EBITDA of somewhere in the, let's say $40 million range, if those are the prices that we see. And again, if I pull in the full G&A cost for the whole company, that came in, I think, around $29 million or so for the quarter, that moves their break-even point up a little bit. And so you can see their break-even point in terms of Henry Hub is probably somewhere around $2.50 per MMBTU. That's where they're actually sort of running neutral. And then above that, they actually are going to have some positive free cash flow. And below that, it will be negative. And, I put adjusted EBITDA in quotes here because I'm really looking at the free cash flow, I think, at this point. So that is one thing. Another thing, in their Q4 results, they burned through a lot of cash. If you look their balance sheet, prior quarter, I think I have it up here. This is at the end of Q3. They had a tad over $600 million in cash. In Q4, in a quarter where they were profitable, they burned down about $140 million of cash. And so, you want to understand where that cash is going. Of course, we expect that a good chunk of this is going towards Driftwood, right? We actually expect them to be burning down cash because they're paying Bechtel and developing the Driftwood site. But let's check where the cash actually go. I took a look into the numbers as best as I can tell and put together a nice little chart. And I guess I have them listed out here, but I'll show the chart in just a moment. So they ended up using about $26 million cash just for additional working capital, right? Their accounts receivable went up, accounts payable went down. That's going to vary from quarter to quarter. I don't worry too much about that. And they spent $58 million that was directly billed for Driftwood construction, and about $4.1 million that they spent on, what they called land improvements. I assume these are for Driftwood. And so really I would build that, add those together, call it about $62 million spent in Q4 on Driftwood. Now, and this is interesting, they also spent, it said, $108 million on development of natural gas properties. And I'm not sure if some of this was, payments for the Insight acquisition or what. I actually didn't. I probably could have dug in a little more and tried to answer that question. Or if this was literally just development of the natural gas properties. And it could be. I know that they had, I think they made a point to say how many wells in progress they had from that they sort of purchased in the Insight acquisition. So maybe this was a lot of, finishing up those wells and getting them producing. I don't know enough about the industry, and I don't think they disclose enough for us to really know the details here. Oh, I'm sorry, my cup's been sitting from the microphone. I hope you could hear me. But anyways, actually more than half of the cash that they spent was for development of natural gas properties. So I thought that was interesting, that they actually are still not spending a majority of their cash burn on Driftwood at the moment. So that is what it is. Now if we go, is this anything interesting? Nah, that's not a tab I wanted to present. Not a big deal. Now, looking forward to 2023. The number one big question that we have here that's actually in terms of their gas production. I have tons of questions for Driftwood. Again, that's a topic for my next video. But today, talking about their gas production in 2023 and how is the company going to be, is it going to be self-sustaining, especially given the lower Henry Hub prices that we're seeing. The first major question that I had is, how much gas I think they're going to produce. Because at one point, and last year, they had been floating sort of this $300 million budget to expand their gas production. And it looks like that has not gone forward. Because if you look, the one interesting tidbit from their presentation, specifically for their gas production, is they are very clear right here on the the very first main slide with their executive summary. Their forecasted average production for 2023 is 225 MMCF per day, which is the same as what they said they did in Q4, right? Approximately 225 million cubic feet per day. So they did in the fourth quarter of 2022. So as it looks right now, it doesn't look like they are going to increase their gas production throughout all of 2023. And it's probably a smart move given the current Henry Hub prices, but again, that's going to be volatile. Time will tell if that's actually a good thing to do or not. Probably also, maybe good from the perspective of they can, spend more time and energy focused on, Driftwood. Although I don't know that this is necessarily has to be mutually exclusive. But anyways, it does answer their question for us that they're not expecting to increase gas production. So I put forth a rough model for every quarter in 2023 to see what does their actual sort of free cash flow look like. Are they even going to be a self-sustaining company at this point? And I believe the answer is yes. I believe they're going to actually make some money. And let me go through some of the details here of my model. So I have this, this row here is their production for each quarter. I assume, again, they produced 20.7 BCF, which was what they produced in Q4. I got the Henry Hub prices. This one I pulled from a couple numbers from the governmental numbers and my prior estimate that I had, or my prior futures numbers that I pulled for March. And then the rest of these are pulled just from the CME Group futures prices in each month. Took the average of the 3 months to get an average price for each quarter. And so this gets us prices, between on the low end in Q1 of 272 per MMBTU, and then in Q4 sort of ramps up to $3.91. So that gets them, revenue in the 50s to $80 million per quarter throughout 2023. And then we look at their operating expenses for those upstream gas production, and I just assume this will be flat, right? No, they're producing the same amount of gas. I assume the operating expenses are going to be flat. Maybe their operating expenses would actually go up a bit. Maybe it gets a little bit harder to produce the gas. I don't know, but for now, I just assumed it was flat for this model. And then I assume $0 of gas development expenses. Again, they're not increasing production, so I just said call it $0. This may or may not be realistic. Again, they might have to actually do some amount of development just to keep producing the same volume of gas. I don't know enough about the industry. Apologies for that. Maybe some of you do. It'd be great if you could, comment that below for the benefit of all of us. And then I also assume their G&A is flat. And this is unlikely to be true. The company is still growing and expanding as they're ramping up to do driftwood. But for now, if we just look at it and we say, hey, if they sort of any incremental increase in G&A that we just sort of attribute to driftwood, and right here we're looking at the company as it is in terms of the gas production, the company as it is, not the company that we want to exist. Keep that flat. That gets us to numbers where the cash flow for operations is positive. Now, one other interesting tidbit out of their 10K is you can see they talk about having notional volumes. So they talk about having open hedges still, at the end of the year, right? They have hedged 9.8 BCF of their production from next year, right? And this is about 12% of their production. So it's not huge, but that's certainly nothing to sneeze at. And I think these mostly were open earlier in the year. And so I did a rough calculation. I'm not going to go into all the details here. It would take even more time than I want to go through in this video. But I did an estimate of how much money I think they're actually going to make from these hedges as they, I assume these were equally distributed across, Q1, Q2, and Q3. I ignored the fact that they say some of these extend through October. I just said, well, take 1/3 of it, put it in each of the first 3 quarters, since they say these extend through October. And I estimated also at what they opened these at, or not what they opened at, what the closing price was at the end of 2022, because that's where they would have booked the value of these in this particular 10K. They have what is the unrealized gain on these. And so I did some math and tried to project out what that's going to look like. And so I actually think they're going to make some money, not tons, but some money. Any money is good, is some money in each quarter here. I'm sorry, this was a copy paste. I should delete those. To see what they're going to make in each quarter of next year from those hedges actually rolling off. And I think it is going to be a positive impact of a couple $1 million, about $2 million ish for each of the first 3 quarters next year. And so that's nothing to sneeze at, right? $6 more million in their pocket to help support the company as it goes. It's not nothing, but $6 million is $6 million to help the company fund itself right now. And then I also looked at interest expense, and I looked at this in terms of what they are paying on their convertible notes and their senior debt. But then I subtracted off what I believe they're going to make in interest on their cash position if they put that in 3-month T-bills, because that nowadays that rate is substantial. And so this is interest expense actually increases throughout the year, as I expect that they are going to be spending down some cash and have a lower cash position that they can put into T-bills. And so this expense goes up throughout the year, and which is kind of nice because Henry Hub prices also go up throughout the year, so the revenue should go up. Anyways, long story short, I guess I already said the long story. That gets you to this amount of free cash flow per quarter. And Q1 I think is going to be pretty small, and it will ramp up throughout the year. Q4 obviously having the highest Henry Hub prices is the absolutely the biggest factor here. And overall, I think in 2023 we should expect them to make about $64 million in free cash flow if we exclude driftwood. Clearly they're going to be burning down money. That's going to be it's entirely own separate thing. But if we just looked at the upstream segment and then also pulled in all the G&A costs from the company, right, they're going to actually still be making money in 2023. Unfortunately, this is a lot less than what we projected. What the estimates were, 3 and especially 6 months ago when Henry Hub prices were much higher. These numbers were somewhere closer to like $300 to $400 million of free cash flow in 2023. There's still a possibility that Henry Hub prices will rise this year, and that come Q3 and especially Q4 when they make most of their money anyways, those prices could be materially higher, and this number could be a lot larger, right? I guess the way that what I would say there is significant upside if Henry Hub prices continue their slight rise, right? If they've actually bottomed and it goes up, it's probably obvious, but this number could be 2 or 3x what my current estimate is if Henry Hub prices go up even another dollar throughout the year. So anyways, that is what I had to present today. Hopefully that was helpful for you to get an idea for next year. Again, I'm mostly looking at it and taking this at least as a positive that Tellurian as a company is funding itself, and there is at least a bottom in terms of where I think the stock can go, unless Henry Hub prices just continue going down and down, because at some point they won't be profitable. But as of right now, I can expect about $64 million of free cash flow next year, which means right now they're trading at like a 15x 2023 free cash flow if you, again, exclude all of driftwood entirely. And clearly, sorry, I shouldn't say clearly, but in my opinion, there's significant value to driftwood and a lot of upside optionality there. And so I think, again, as I've stated many, many times in the past, I think looking at Tellurian as a natural gas producer is one way to, convince yourself, at least I convince myself, that there's some limited downside in the stock. So anyways, thank you very much for watching, and have a good one.